what are you seeing so far? I mean, obviously, it's very difficult for landlords when their tenants are not allowed to make any money due to a shutdown.
Sure. To take a quick step back, Terra is a real estate credit-focused asset manager with nearly 2 decades of experience investing throughout multiple economic cycles. Given where we've been living in a very low-yielding world for the last few years, we didn't think it made sense to take excessive risks and as such conservatively position our portfolio away from economically sensitive asset classes. What we're living through today is an exogenous event that nobody could have predicted. However, as you noted, all real estate property types are facing challenges, which gets me to what I view as an underlying bifurcation in today's market. The commercial real estate world is split into 2 players. One, who took a disciplined approach over the last few years, especially in a mature phase of the economic cycle, and 2, those who are more aggressive and are either over-leveraged or have portfolios with economically sensitive property types. As an investor, of course, you can't predict these type of exogenous events, but you can build a resilient portfolio and be adequately prepared.
Vic,
hospitality and retail.
Vic, I'm wondering, so retail and hospitality, as you were getting to, was the big area that a lot of people see a lot of pain. Wondering if you think that's priced into the commercial real estate investments that you're seeing right now, or have investors gotten there yet?
Sure. I mean, look, it's a good question. Hospitality and retail have been hit very hard, which was clear early on, with significant numbers of properties being closed or running at uneconomic occupancy levels. That being said, I don't think any property type is fully immune to the fundamental challenges in changes in demand. A few examples of that are, one, in industrial, which there's been a significant investor demand with the rise of e-commerce. But it's important to keep in mind that very few industrial properties are leased to Amazon, and there's a significant amount of properties with weaker credit tenants, such as over-levered retailers. And as those businesses continue to be stressed, you could have significant effect. I think what you're seeing right now, as I pointed out, is you're seeing this bifurcation between disciplined investors who are very conservative over the last few years and those who are more aggressive and are either over-leveraged or have portfolios that are economically filled with economically sensitive property types.
Right.
And for many of those groups, they've been focused on asset management triage, dealing with unprecedented amounts of forbearance requests for the last for the next 90 to 120 days.
Vic, what about the banks here? You mentioned a lot of these properties were already over-levered. There's $2 trillion worth of CRE mortgages maturing in 5 years, more than half held by banks. Are bankers tightening their lending standards here in fear of the losses that they might see very soon?
It's a good question. You haven't seen a wave of defaults yet, and I think that's because lenders, banks, and servicers really have been in asset management triage mode, dealing with the unprecedented levels of forbearance requests, especially those that have significant concentration to economically sensitive property types. So ultimately what you have is massive challenges ahead, as you point out, with $2 trillion of commercial real estate mortgages maturing in the next 5 years. And today you have over $150 billion in CMBS loans that are on the watch list.